Hey everyone, welcome back. With the 2024 election just behind us, it seems like a lot of you are wondering about, the stock market and if there could be some kind of link between, elections and those big shifts, those big turning points in the market.
Yeah, it's definitely something people are talking about. And you've actually sent over some research from Bravo's research that I think is going to be really interesting to dive into. They've gone all the way back to the 1920s looking at this.
Oh wow. Okay, so they've really gone deep on the historical data here. So what exactly did they find? What's the headline from their research?
Well, the big thing that jumps out is this pattern they've identified. There were three major market downturns. You've got 1929, 1973, and 2001. And all three of those actually followed a presidential election.
Really? All three. Okay, so which elections are we talking about specifically?
So we're looking at the elections of Hoover in 28, Nixon in 72, and then Bush in 2000.
Wow, okay, so three major crashes all after an election year.
Mm.
I mean, that's got to make you wonder if there's something more to it than just coincidence, right?
Right, and that's exactly what Bravo's research is trying to get at. They dig into some possible explanations, but it's really important to remember that correlation doesn't equal causation.
Right.
Just because these events happened in a certain order doesn't necessarily mean one caused the other.
Yeah, that's a good point to keep in mind. But still, the pattern is pretty striking.
Yeah.
So what makes this relevant for us right now, in this post-2024 election world?
Well, Bravo's research makes the case that the market right now is showing some similarities to those periods before the downturns we were just talking about.
Oh, okay, so similarities to those periods that, ended with big crashes, that's
Yeah.
that's a little unsettling. Can you tell me more about these similarities? What exactly are they seeing?
Sure. They highlight three main areas where they see parallels. First, they point out that stock valuations are really high right now. It's kind of similar to what we saw in 1929 and 2000, right before those big market drops.
Okay, high valuations. So that's one similarity. What
Yeah.
else?
The second thing they point out is consumer sentiment. It's a little surprising because the market's been growing. But despite that growth, consumer sentiment is actually pretty low. It seems like people are feeling uncertain about the economy, and that can sometimes be a warning sign.
Okay, so high valuations, shaky consumer confidence.
Yeah.
That's two strikes already. What's the third thing they're worried about?
The third thing is the interest rate environment. Right now, the Federal Reserve has rates set at around 5%, which is higher than long-term rates.
Yeah.
And this creates something called an inverted yield curve. And historically, that's been a pretty reliable predictor of recessions.
Hold on. An inverted yield curve. Can you remind me what exactly that is and why it matters so much?
Sure. So normally, long-term interest rates are higher than short-term rates because, lenders expect to be compensated for tying their money up for a longer period. But when this relationship flips and short-term rates are actually higher than long-term rates, that's what we call an inverted yield curve. And what it means is that investors are kind of nervous about the long-term economic outlook, so they're demanding higher returns for those shorter-term loans.
Oh, okay. So it's like a signal that people aren't so confident about the future, and that's showing up in how interest rates are structured. So with all three of these factors in play, high valuations, low consumer sentiment, and an inverted yield curve, I mean, are we basically looking at another market crash just like those other times? Is history about to repeat itself?
That's where things get kind of interesting because even with, these historical parallels and all these potential warning signs, Bravo's research is actually predicting that the market will keep growing, at least for a few more months.
Really? Wow. Okay.
And
So they're basically saying this time is different. What's their reasoning there? What makes them so optimistic?
well, they've identified what they call an ideal market environment. And they think that this environment outweighs those historical concerns we were just talking about. It's not just one single thing, but it's like a combination of factors.
Okay, interesting.
Yeah.
So what exactly are these factors that make up this ideal market environment?
So the first thing they point to is the economic growth we're seeing right now. And, you mentioned earlier that those past crashes also happened during periods of growth. But Bravo's research emphasizes that the growth we're seeing now is really stable. And they believe that this stability, it creates a more predictable and supportive environment for businesses and investors.
Okay, stable growth. Got it.
Hmm.
What's the next element in this ideal mix?
Next, they look at inflation. And I know inflation has been a big concern for a lot of people. But Bravo's research points out that it's actually been pretty subdued lately.
Yeah.
This gives the Federal Reserve more flexibility to adjust interest rates without, spooking the market.
So basically, low inflation gives the Fed some breathing room to make adjustments without, triggering a sudden downturn.
Yeah.
Okay, I'm following you. But earlier we were talking about how the Fed having rates at 5% was a potential red flag because of that inverted yield curve.
Mm-hmm.
Now you're saying low inflation gives them more flexibility with rates.
Mhm.
So has the Fed's position on interest rates changed?
You've hit on a really important point. The situation has actually evolved since those initial rate hikes we talked about.
Hmm.
The Fed has started to lower rates in response to, the changing economic conditions.
So they raised rates at first, which caused some concern because of the inverted yield curve, but now they're lowering them again. So it sounds like they're trying to, walk that tightrope between keeping inflation under control, but also not stifling economic growth.
Exactly. And Bravo's research sees this change in the Fed's policy as a positive sign for the market.
Okay, so we've got stable growth, we've got low inflation, and we've got the Fed lowering rates. Those are the three pillars of their ideal market environment argument. But let's play devil's advocate here for a second. Even if all of that's true and the market keeps going up for a few more months, wouldn't that just be delaying the inevitable crash? Like, we're just kicking the can down the road, but eventually we're going to trip over it.
Yeah, it's a valid point. And Bravo's research does acknowledge that possibility. But they also point to their technical analysis to support their prediction of continued growth.
Okay, technical analysis. You mentioned that term earlier. Can you explain what that means, for me and for anyone listening who might not be super familiar with, stock charts and all that?
Of course. So basically, technical analysis is about looking at charts and patterns in the stock market's price movements to try and identify, trends and signals. What Bravo's research is seeing in their technical analysis is that the S&P 500 is trying to break out above a key resistance level.
Okay, so I'm picturing a stock chart in my head. But what does it mean for the market to break out above a resistance level? What's so significant about that?
Imagine like a climber trying to scale a mountain. There are going to be certain points along the climb that are really tough. They require extra effort to get past. Those are like resistance levels on a stock chart. So if the climber can push through those tough spots, if the market can break above that resistance level, it suggests that there's enough momentum to keep moving higher.
So they're seeing this breakout attempt on the charts, and they're interpreting that as a sign of strength and upward momentum. And that, combined with their ideal market environment argument, is what's leading them to predict the S&P 500 reaching 6,500 points by the end of the year.
Exactly. They're combining their analysis, the overall economic picture, with those technical observations to arrive at their bullish conclusion.
It's definitely a thorough approach. But like you said before, even Bravo's research admits that this is just a prediction. Nobody can say for sure what the market will do.
That's absolutely right. And that's part of what makes this whole discussion so interesting and potentially challenging for investors. We have these historical patterns that are kind of urging caution, but then we have this in-depth analysis from Bravo's research that paints a much more optimistic picture.
It's almost like we're standing at a fork in the road, trying to figure out which way to go. So how do we reconcile these two seemingly opposite viewpoints? What are the key takeaways for someone who's listening and trying to figure out, what all of this means for their own investments?
It can definitely feel like a puzzle sometimes, trying to make sense of all these different perspectives. History's telling us one thing, but then we have Bravo's research with their data and their optimistic outlook. So where does that leave us?
Yeah, it's a lot to process, especially if you're trying to, make smart decisions about your investments. So how do we navigate all of this? How do we cut through the noise and figure out what to do?
Well, I think the first step is just acknowledging that complexity. It's not as simple as saying history always repeats itself or this time it's different. There are valid points to be made on both sides, and that's where, critical thinking becomes so important.
So we're not just blindly following historical patterns, but we're also not completely ignoring them either. It's about finding that balance.
Right. Exactly. History can be a really valuable guide. It can give us context, but it's not a crystal ball. The market is constantly changing. There are so many factors at play. What worked in the past or what didn't work in the past doesn't necessarily mean that's what's going to happen in the future.
Right. We can't just assume that what happened before is guaranteed to happen again. So what else should we be thinking about as we try to make sense of all this information?
I think it's crucial to remember that nobody can predict the market with 100% certainty. Not even the most experienced analysts. Bravo's research has made a strong case for their optimistic outlook. But it's still just a prediction. There are always things that can happen, unexpected events, things we can't foresee that can throw everything off course.
Right. A market definitely has a way of humbling us. So with all this uncertainty, how should people approach their investment decisions? Should they be buying stocks, selling stocks, hiding cash under the mattress? What's the best move here?
Unfortunately, there's no magic formula or one-size-fits-all answer. Every investment strategy should be personalized. It should be tailored to your individual circumstances, your goals, your risk tolerance, and your time horizon. But what I think this deep dive really highlights is the importance of being informed, diversified, and prepared, no matter what your specific approach is.
Okay, let's break those down. Being informed, I think we've definitely covered that today. What about diversification? What does that mean in this context?
So diversification is basically about spreading your risk. Don't put all your eggs in one basket. Don't bet everything on, one single stock or one sector or even one asset class. By diversifying your portfolio across different investments, you're creating a safety net. If one part of your portfolio takes a hit, the other parts can help to cushion that blow and keep you on track.
That's a great way to think about it. And what about being prepared? What does that look like, practically speaking?
Being prepared means thinking through different scenarios and having a plan for each one. Ask yourself, what will I do if the market keeps going up and defies those historical patterns? And what will I do if it takes a downturn? Having a strategy in place beforehand based on your own individual goals and risk tolerance can help you make better decisions when things get emotional. When the market is going up or down and you're feeling that pressure.
That's such a good point. It's so
Yeah.
easy to get caught up in the hype, whether the market is going up or down. Having that plan can help you stay grounded and make decisions that are actually in your best interest long term. So as we wrap up this deep dive, what's a one big takeaway you'd want to leave our listeners with?
I would say be an active participant in your financial journey. Don't just blindly follow predictions or advice. Do your own research. Dig into the data, ask questions, and most importantly, think critically about the information you're getting.
I love that. Informed skepticism and independent thinking, those are so important, especially when it comes to something as complex and constantly changing as the financial markets may. And who knows? If Bravo's research is right and the market does keep climbing, even with those historical warning signs, it could change the way we think about what drives market behavior. Is this really a new era? Or are we just delaying the inevitable?
That's the thing about the markets. They're always challenging our assumptions and forcing us to learn and adapt. And maybe that's where the real opportunity lies, not just in watching what the market does, but
Yeah.
in trying to understand why it's doing it.
Such a great point to end on. Well, we hope you enjoyed this deep dive. Remember, understanding the financial markets is a journey. It's always evolving. So keep learning, keep exploring, and make informed decisions that align with your financial goals. Until next time.